Okay, let's unpack this. We've all seen it happen, right? A company announces these fantastic sales figures. Revenue is up, say, 20%.
Yeah, everyone's celebrating.
Everyone's celebrating. But then the final results come in and the profit has either, skyrocketed by 60% or it's completely fallen off a cliff.
And management is left just scratching their heads. They can't explain why the sales volume didn't just, well, translate one-to-one to the bottom line.
That whole thing, it's really a symptom of relying only on traditional financial accounting.
It is. I mean, that type of accounting, the kind that gets published externally, it's a brilliant historical scorecard. It tells you very accurately what you made and what you spent last quarter.
It's like having a perfect map of a road trip you took yesterday. It's a great record, sure.
Mm-hmm.
But if you want to know what happens if you take a different route tomorrow, that map is, well, it's pretty much useless. Traditional accounting just lumps all the operating costs together.
And that makes it impossible to forecast. You just don't know which costs are tied to volume and which are, fixed overhead.
And that inability to predict, that is the precise blind spot we want to eliminate in this deep dive.
Right. Our mission here is to unlock really the foundational principle of managerial accounting, which is all about understanding cost behavior.
And we're going to do that with two really powerful internal tools, the contribution margin income statement and cost volume profit analysis, or CVP.
Exactly. This is the difference between just recording history and actually building a predictive model for the future.
For this, we've synthesized insights from a few key frameworks on contribution margin and operating leverage, and we're going to use one fantastic case study as our blueprint.
That's the Jules Corporation's baseball glove data. It's a perfect example.
Okay, so let's set the stage with the initial problem. Jules Corporation sells baseball gloves. At a starting point of 1,000 gloves sold, their traditional financial statement looks something like this.
Okay, so the selling price is $200 per glove. That's $200,000 in total revenue. And their total operating costs, as one big lump sum, are $173,000.
Which leaves them with a reported profit of, what, $27,000?
A decent profit. But now if you're the CEO and you ask your manager, okay, what happens if we push marketing and increase sales by 20%?
The manager can't give you a straight answer.
They can't. They have no way of knowing how that $173,000 cost pile is going to react. And, I mean, that uncertainty is just unacceptable for making strategic decisions.
So the first step is a kind of structural reform. We have to move from that traditional format to the managerial one.
The contribution margin income statement.
Exactly.
And this is a really fundamental change. You're replacing the GAAP-mandated format with an internal view that sorts costs based on their behavior.
We're basically asking, what moves when production changes and what stays put?
Right. And in the Jules case, if we reformat that total $173,000 cost figure, we see two very clear categories.
Okay, first up are the variable costs.
The leather, the lacing, the direct labor.
All the stuff that goes into each glove. And that clocks in at $110 per glove. So for 1,000 units, that's $110,000 total.
The rest of it, that's the fixed costs. These are the costs that happen whether they make 100 gloves or 1,000 gloves.
Like the factory rent.
Factory rent, depreciation on the machinery, management salaries, those things. And those fixed costs are constant at $63,000.
Okay, so now we can define the crucial number here, the core metric, contribution margin, or CM. What does this number, which is $90,000, actually represent for a manager?
The contribution margin is what's left from your sales revenue after you've covered every single direct variable expense that was required to produce that unit.
So it's the cash that sales generates.
That is then available to cover all your fixed costs. So $200,000 in revenue minus $110,000 in variable costs equals that $90,000 total CM.
And on a per unit basis, that's super clear. $200 price minus $110 in variable costs leaves $90 per glove.
Every single time a glove is sold, $90 goes into a bucket. And that bucket has to pay for the factory rent first.
Right. And this is probably a good time to introduce a really vital caveat that underpins all of this.
Oh, yes. The relevant range.
Explain that.
That $63,000 fixed cost figure, it only holds true within a specific range of production. Let's say from 500 gloves up to maybe 1,500 gloves.
Okay.
If Jules Corp suddenly decides to, I don't know, open a second factory, that fixed cost base jumps up. and all our calculations are immediately invalid. We have to assume our current operational scale stays steady.
That's a critical piece of context. Okay, so back to the CM statement logic. We have the $90,000 CM. If we subtract the total fixed costs,
The 63,000.
we land precisely back at that original profit figure, $27,000. So the math is sound, but it's structured in a way that's actually useful.
And that clarity is exactly why it's kept internal. I mean, when you compare this with financial accounting, you see why CM statements aren't published externally under GAAP.
It's not just about hiding your cost structure from competitors, although I imagine that's part of it.
That's a factor, sure. But GAAP prioritizes objectivity and separating fixed and variable costs that often involves some managerial judgment, some estimation. Financial accounting demands objective figures.
Whereas managerial accounting demands figures that are useful.
Exactly. Even if they involve a little bit of estimation.
That makes perfect sense. Okay, so we've separated the costs. Now the real question is, how do we use that structure to predict the future? And that brings us to the strategic power of operating leverage.
This is the aha moment. Let's run that test case. What if Jewel Corporation increases sales by 20%? From 1,000 gloves to 1,200?
A manager using the old-style accounting would probably just guess profit goes up 20% too.
A very common mistake.
But with the CM structure, we can see exactly why that's wrong. Okay, so revenue climbs 20% to $240,000.
And variable costs, they track that increase perfectly. They also go up 20% to $132,000.
Which means the contribution margin also increases proportionally by 20%. It hits $108,000.
And here's the lever, the fixed costs.
They stay at $63,000. We're still in that relevant range, 0% change.
So the profit calculation is now $108,000 in CM minus that same $63,000 in fixed costs, which gives us a new profit of $45,000.
Whoa, hold on. A 20% increase in sales led to the profit jumping from $27,000 to $45,000. That's an $18,000 increase. That works out to a 66.7% leap in profit.
And that disproportionate jump, the fact that profit changes at a much faster rate than sales, that is operating leverage.
So what's the mechanism? Why does that happen?
It's actually pretty elegant. We already covered the $63,000 in fixed costs at the 1,000 unit level,
right.
Once those are covered, every new dollar of contribution margin, every extra $90 per glove sold flows 100% to the bottom line as pure profit. That $18,000 increase in CNLI is all profit because the fixed cost buffer was already handled.
Okay, so this sounds amazing. High leverage means huge potential upside. But it also sounds like it introduces a lot of strategic risk.
It does.
If fixed costs are high and that 63 grand isn't going to shrink, why would a manager ever invest in more fixed costs like automation if it just makes the downside risk worse?
Well, that's the strategic gamble, isn't it? A company with high fixed costs is deliberately choosing to chase high leverage. They're betting heavily on volume.
If they hit their targets, they win big.
They win big. But if sales decrease by 20%, that leverage works viciously against them. The profit falls by much more than 20% because that big, unchanging fixed cost base just eats away at the smaller contribution margin. High fixed costs mean high potential, but also very high risk.
And that just highlights the danger of that linear forecasting trap.
Oh, absolutely.
If a manager had just stuck with the simple idea that profit was $27 per glove, they would have forecasted, what, $32,400 for 1,200 gloves?
And the actual profit is $45,000.
They would have underestimated their performance by $12,600. That could mean missing out on bonuses or crucial investment opportunities.
The cost of ignoring cost behavior it's substantial.
Okay, so let's pivot a little. Calculating every single unit is great, but managers often need quicker shortcuts, especially if they have a lot of different products.
Right.
And that takes us into using ratios, specifically the contribution margin ratio, or CMR.
The CMR gives us this clean percentage that we can apply to any sales dollar. It's calculated by taking the contribution margin and dividing it by the sales revenue.
So for Jules Core, that's $90,000 divided by $200,000, or even easier, $90 per unit divided by the $200 price.
And the result is 0.45, or 45%.
So for every dollar that comes in the door, 45 cents is ready to cover the fixed expenses and then contribute to profit.
Exactly. And the rest of that dollar,
That's the other side of the coin.
it's defined by its complement, the variable cost ratio, or VCR. So 110,000 in variable costs divided by 200,000 in revenue. That gives you 0.55 or 55%.
Meaning 55 cents of every sales dollar is immediately eaten up by the direct costs of making the product.
And that fundamental relationship always holds. CMR of 45% plus the VCR of 55% has to equal 100%.
Every sales dollar is either consumed by variable costs or it remains as contribution.
And this ratio is incredibly powerful for quick forecasting. Say, for example, Jules is planning a $50,000 revenue boost next year across all its different glove lines.
You don't need to recalculate the volume for every single type of glove.
Nope. You just multiply that planned revenue increase by the CMR.
$50,000 times 45%. That's a $22,500 increase in profit. Just like that.
It's a rapid, high-level, and really accurate shortcut for any dollar-based planning.
And that leads us directly to formalizing all of this into a full model.
The CVP equation. This is the algebraic framework that really turns accounting into a forward-looking planning engine.
The CVP framework is like the algebraic master key. It's really just the CM statement written out as a formula. Sales revenue minus variable costs minus fixed costs equals profit.
What makes it so versatile is that you can express it in a few different forms. I mean, you can use the aggregate totals. But for volume analysis, we like the unit-based form.
Which is selling price minus variable cost, all of that times quantity, or Q minus fixed costs equals profit.
Right. And if you're more focused on cash or total revenue, you use the ratio-based form.
That's the contribution margin ratio times sales revenue, or S minus fixed costs equals profit. The power here is that you can solve for any of the unknowns.
Let's test it out with our Jules Corp data. Price is 200, variable cost is 110, fixed cost is 63,000.
Okay, let's start with the most critical number every manager needs to know, the break-even point. What volume, what Q do we need to sell just to get profit to zero?
For that, we use the unit-based form. We set up the equation 200 minus 110 times Q minus 63,000 equals 0.
So that simplifies to $90 times Q equals $63,000.
And if we solve for Q, the company needs to sell exactly 700 gloves just to cover those fixed costs.
That 700 unit mark is the moment you go from losing money to starting to make money.
And that number is, it's immensely actionable intelligence. You don't just put it on a shelf. The sales team now knows the first 700 gloves they sell are just covering overhead.
They might change their whole compensation plan around that.
Exactly. They could structure it to hit 700 as fast as possible, knowing the real profit, the real bonus money, only starts kicking in on glove number 701.
Okay, let's push it. Scenario 2. What total sales revenue, or S, is needed to hit a pretty hefty target profit of $60,000?
Now we switch to the ratio form since we're solving for a dollar amount. Our CMR is 0.45.
Okay.
So we plug in the numbers. 0.45 times S minus 63,000 equals 60,000. Algebraically, the fixed costs and the target profit, they combine.
So the total contribution margin we need is $123,000.
Right. Then we just divide that 123,000 by our CMR of 0.45. And the required sales revenue S to hit that $60,000 target is $273,333.
And this is how managers set budgets. They can't just wish for 60 grand and profit.
No, they have to back calculate the precise revenue required.
Yeah.
And that lets them assess if that sales target is even, feasible in the market.
Okay, one final quick example of the flexibility here. Let's say we're selling 1,000 gloves and we need to achieve a $40,000 profit. What does our selling price P have to be?
Now we're solving for the strategic pricing variable. We go back to the unit form, but we solve for P.
Okay, so P times 1,000 minus $110 times 1,000 in variable costs minus the $63,000 in fixed costs has to equal our $40,000 target.
You calculate the total revenue you'd need to cover all those costs plus the profit, which comes out to $213,000.
And since we're selling 1,000 units, the math is easy. The required selling price is $213.
And that's the strategic insight right there. If your marketing team comes back and says, look, competitors are at $205, we can only charge $205 for this glove.
Then your plan is busted.
Your plan to make $40,000 profit is mathematically impossible, unless you can find a way to reduce your variable costs, or critically, reduce that $63,000 fixed cost base. CVP analysis literally dictates your strategy.
It just confirms that understanding cost behavior fixed versus variable is the absolute foundation of all managerial planning. The contribution margin format is the tool that lets us calculate operating leverage, understand our risk, and actually predict profit with some certainty.
And for you, the listener, this gives you the formula and the power to conduct sensitivity analysis really quickly. You don't need to build these massive, complicated spreadsheets. You can answer crucial business questions like, what if sales drop 10%? Or what if we try to raise our price by $5? Almost instantly.
And that leads us to our final thought for you to reflect on. We kept stressing that CVP analysis only holds true within the relevant range, that volume where fixed costs stay constant.
But real strategic growth often forces companies out of that range.
So consider this. We saw that Jules Corp's profit increased dramatically when sales went up 20% because their fixed costs stayed put at $63,000.
Right.
What specific large-scale business decisions would completely shatter that relevant range? Think about deciding to double capacity by building a brand new, highly automated second factory. Or maybe signing a $10 million multi-year celebrity endorsement deal.
These moves would fundamentally change the entire fixed cost structure. It would massively increase the strategic risk and require managers to immediately reassess their whole operational model. They'd have to set a completely new, much higher break-even point. Just think about how quickly the rules of the game can shift when management decides it's time to scale up.